The Nuburu Inc. stock, trading under the ticker BURU, last closed at $0.34 USD on October 20, 2025 at 4 p.m. GMT -4, as the market is currently closed. The pre-market session saw a slight dip, with the price moving to $0.32 USD, a change of approximately -6.26% from the previous close. Now here's the interesting angle right out of the gate. Most retail investors look at a sub-dollar stock like BURU, especially one with a recent history of substantial dilution and volatility, and their immediate thought is that it's a speculative gamble purely tied to the early-stage high-tech promise of its blue laser technology. The expectation is a binary outcome, moonshot or bankruptcy, driven solely by industrial laser adoption. But the reality is far more complex, and a recent radical shift in strategic focus is the development nobody anticipated, a move that fundamentally changes the core proposition of the company and is the actual catalyst to watch. This isn't just a laser company anymore. It's attempting a hard pivot into a completely different sector, and that tension between the company's original identity and its new ambition is where the investment story truly lies. The general belief about Nuburu Inc. has always been centered on its blue industrial laser technology. This expectation is founded on the genuine technical merit of blue lasers for welding and 3D printing of highly reflective materials like copper and aluminum, critical materials for high-growth sectors like electric vehicle batteries and consumer electronics. The narrative was simple. As EV production scaled and demand for better, faster, and more precise welding solutions increased, Nuburu would naturally capture a large slice of that industrial machinery market. This is a powerful, yet slow-moving industrial narrative. However, the contrarian, deeper take that smart observers must consider is that the company's stock price movements over the last few quarters have been driven less by the industrial sales cycle of their blue laser technology, which remains nominal, and more by corporate restructuring and strategic announcements related to an entirely new venture. The stock's massive volatility is a direct consequence of this dramatic shift, not necessarily the inherent business of selling lasers. The recent day range of $0.31 to $0.37 USD, though small in absolute terms, represents significant percentage volatility, which is characteristic of a microcap undergoing a transformation and being heavily influenced by low-volume, high-impact trades. Analyzing the recent stock movement, the intraday swings have been incredibly sharp, even on low-volume days, suggesting a retail-driven, momentum-based trading pattern rather than steady institutional accumulation. This stock is not currently a component of the core offerings in platforms like Schwab Intelligent Portfolios or Fidelity ETFs, nor is it the kind of stock a passive online investment strategy would hold. It's an active, high-risk trade. We need to look at the news flow. In recent weeks, the company has explicitly announced a transformation plan that involves building out a defense and security hub through strategic acquisitions. This is the unexpected reality. They've gone from high-power lasers for automotive manufacturing to a focus on defense tech, security, and critical infrastructure resilience. This strategic pivot, rather than a breakthrough industrial contract for a blue laser, is what sparked the last few spikes and drops. The market is trying to price a company that is selling two completely different stories. The old story, laser tech, has been slow to materialize into meaningful revenue. The new story, defense and SaaS, is all potential and projected revenue from yet-to-be-finalized deals, like the projected acquisition of a controlling interest in Orbit SRL, a SaaS startup specializing in operational resilience. This type of corporate activity is often met with extreme skepticism, especially by institutions, due to the execution risk involved, but can attract speculative retail interest looking for the next multi-bagger. Institutional activity over the past few quarters further underscores this transitionary and speculative environment. While the overall percentage of institutional ownership is remarkably low, sitting at well under 5%, The quarterly activity is telling. The last reported 13F filings from June 2025 indicated a net increase in shares held by institutions, though the total dollar value remains very small. Firms like Vanguard Group and Gato Capital Management LLC showed positions, albeit small, and some increased their stake. Now, it's crucial to understand these movements in context. For a large fund, a small position in a microcap like Nuburu is often a minuscule, highly diversified hedge or a placeholder from the company's SPAC days, not a high-conviction bet. However, the fact that some are increasing their positions after the initial dilution phase, even marginally, might be an indicator that they are at least paying attention to the new defense tech narrative and the possibility of a revenue stream that is independent of the capital-intensive blue laser production cycle. This is a classic case of expectation versus reality. The expectation is that institutional owners wouldn't touch this with a 10-foot pole, given the volatility and lack of earnings. But the reality is that a few are quietly holding or even adding, suggesting a potential belief in the new direction. Let's quickly address what the company actually does or did before the pivot. Nuburu Inc. was founded to design and manufacture high-power, high-brightness blue laser systems. The core technical advantage lies in blue light being significantly more efficiently absorbed by materials like copper, gold, and aluminum compared to traditional infrared lasers. This efficiency translates to faster, higher quality, and more repeatable welds and 3D printing. The problem, which led to the low revenues, is the massive capital expenditure and lengthy sales cycles involved in penetrating industrial manufacturing giants in the EV and electronics space. Their older financial reports were characterized by minimal revenue and significant net losses, typical of a pre-commercialization or early-stage hardware company. For example, their outlook for the full year 2023 anticipated total revenue greater than $3 million, but an EBITDA in the range of -$21 to -$23.0 million. This high burn rate is the very pressure that forced the strategic pivot. This historical context is vital because the original technology is not dead. The company is attempting to leverage its blue laser technology expertise in the defense sector, where its high precision and power could be applied to new types of military applications. This ties the old business to the new. Now, let's focus on the new business model and future outlook. The new strategy explicitly targets long-term, sustainable growth across high-value government and enterprise markets by expanding into complementary sectors like defense tech, security, and critical infrastructure resilience. The immediate catalyst is the acquisition program. The company aims for the Defense and Security Hub to contribute an estimated over $50 million in 2025 revenue, subject to the finalization and consolidation of those acquisitions. If this projected revenue materializes, it would be a substantial, market-moving figure compared to their historical performance. The promise of a software-as-a-service model through the Orbit acquisition is a massive shift, promising a more scalable business with potentially higher margins than industrial hardware manufacturing. This move towards defensible, high-margin government and enterprise contracts is an attempt to create a credible, revenue-generating reality that far exceeds the market's current lowball valuation and skeptical expectation. This is the true tension point. Can a management team of a microcap laser company execute a complex, multifaceted acquisition and integration strategy in an entirely new vertical? The recent warning letter from NYSE American regarding their compliance procedures for announcing the dual CMO structure, though administrative, adds a small layer of doubt about corporate governance during this critical transition period, an important consideration for anyone engaging in self-investing. The future outlook, therefore, must be framed by two distinct scenarios. Scenario A: reality exceeds expectation. The announced acquisitions, particularly the Defense and Security Hub and the SaaS asset, close on time and the projected $50 million in revenue begins to materialize in late 2025 and early 2026. This would provide the cash flow and business stability needed to continue funding blue laser research for highly lucrative defense applications, validating the pivot. In this outcome, the stock price would likely experience a significant re-rating as a growth-oriented defense tech microcap, potentially moving it back toward or even above the $1 compliance threshold, thus de-risking the listing status. This would demonstrate successful execution in the high-stakes environment, where platforms like Fidelity or Interactive Brokers might start listing it on their most active small-cap scanners. Scenario B. Expectation falls short. The acquisitions face delays, fall through, or fail to generate the projected revenue, or the cash position of around $6 million is insufficient to manage the current burn rate while simultaneously closing complex international deals, like the ones involving Techne SPA and others. This scenario would leave the company back where they started, a low-revenue laser company that exhausted its cash